What's up, ladies and gentlemen? Welcome to the Beat of Business with me, Ravi Wadan. And today we're going to be talking about 3 quality tech stocks that you should strongly consider buying right now. One of the strategies that you should consider using when buying these stocks is dollar cost averaging into your position. Now, I'm a big fan of dollar cost averaging, and in a nutshell, with dollar cost averaging, you are building your position in a stock over time by investing equal dollar amounts or certain dollar amounts in a stock at regular intervals. So instead of attempting to buy a stock at the perfect time, you buy in at a range of different times and prices. As a quick example, let's say that you have $1,000 allocated to invest in a certain stock. Now, instead of investing that $1,000 all at once, you could invest $100 every day at 11 a.m. for the next 10 days. That's dollar cost averaging. Well, enough of the small talk. Here are my 3 technology stock picks for this month. But before I dive deep into them, please do me a quick favor and hit that like button, hit that subscribe button, and hit the notification bell because it helps my channel out tremendously. My first stock pick is Apple. Currently, Apple is trading at $149.23 a share and is up 0.39% on the day. Now, Apple has a market cap of $2.467 trillion, a PE ratio of 29.21, and a 52-week trading range of $107.32 on the low end and $157.26 on the high end. There are currently 40 analysts that cover Apple stock with an average price target of $168.99, which is approximately 13% higher than where it trades right now. And if we look at Apple's recommendation rating, it's a 1.8, which is in between a strong buy and a buy on Yahoo Finance. There is no question that Apple has established itself as one of the most premier brands on the planet. Their smartphones, tablets, smartwatches, and computers are some of the most desired products in the world. But for me, there are a few other catalysts that I think will drive the share price higher in the months and years to come. The biggest reason is because of Apple's custom-built M1 chip, which brings unbelievable battery life and performance to its MacBooks and iPads. And recently, the company introduced their all-new M1 Pro chip and the M1 Max chip, which offer even more computing power than the standard M1, which was already blowing the competition out of the water. Apple has designed its iPhone chips for a while now, but Apple's foray into designing its own chips for its computers and tablets will be a growth driver for 2 reasons. The first reason is, who doesn't want more computing power? I know I do, and with the M1 chipsets, Apple has done just that. Not only are these M1 chipsets more powerful, these processors are also much more efficient than the Intel processors that powered Apple laptops and computers for many years. These M1 line of chipsets are important because they actually reduce Apple's expenses by $75 per unit, according to JP Morgan analyst Sumit Chatterjee. And it's simple economics. When you are reducing your expenses, your gross margins will increase over time if you maintain the same selling price for your product. The second catalyst that is going to drive Apple's revenue going forward is its services business. Apple's service business posted a gross margin of 70% in its most recent quarter, and Apple has expanded its services offerings in recent years, and the lineup now includes subscription products like Apple TV Plus, Apple News Plus, and Apple Fitness Plus, as well as other services like Apple Pay and the infamous App Store. And Apple also recently introduced some privacy changes to its iPhones back in April of this year, which makes it more difficult for advertisers to collect data and target users. And the company sort of touted the move as a way to protect consumers, but the move also boosted Apple's market share in the advertising business. So wait, you're telling me Apple made it more difficult for advertisers to advertise on Apple's platform and instead targeted users with its own ads? Yes, that's exactly right, and it's sort of a win-win for Apple going forward. Consumers get the privacy they want, and Apple has more control over the advertisements that they place on their platform. The bottom line is that Apple is a massive company with an almost $2.5 trillion market cap. But Apple, at least in my opinion, remains the gold standard in the consumer electronics industry. And with the holiday season on the horizon, Apple, at least to me, seems to be a technology stock to consider buying right now. My second stock pick is Facebook. It's definitely been a rough month for Facebook. First, they had an outage that took down Facebook, Instagram, and WhatsApp for a couple of hours, and then they got hit with whistleblower testimony from Frances Haugen, who accused the company of acting in the interest of profits rather than people. I mean, come on, is anyone surprised that Facebook is being accused of acting in the interest of profits rather than people? Currently, Facebook is trading at $314.76 a share and is down $13.93 or 4.24% on the day. Facebook currently has a market cap of $887.354 billion, a PE ratio of 22.07, and a 52-week trading range of $244.61 on the lower end and $384.33 on the higher end. There are currently 50 analysts that cover Facebook stock, and those 50 analysts have an average price target of $417.22, which is well above its current trading price of roughly $314. And if we take a look at Facebook's recommendation rating, it sits at a 1.9, which is in between a strong buy and a buy on Yahoo Finance. And as a result of the recent negative news that plagued Facebook, it is down about 19% from its peak in September. Now, there's no question that Facebook will probably face some consequences in regard to the Haugen testimony, which will likely be in the form of greater oversight and regulation. But the fact of the matter is that the greater oversight and regulation will most likely apply to all social media companies, not just Facebook. People are scared to buy Facebook right now, and people are selling off their shares as showcased by the steep decline in Facebook's share price. But if you ask me, these are the types of opportunities that you wait for as an investor to buy a quality company like Facebook at a discounted price. In its recent Q3 results, which were reported yesterday, the company's GAAP earnings per share of $3.22 beat consensus estimates by 5 cents, while its reported revenue of $29.01 billion missed analyst estimates by $510 million, but it was still a 35.1% increase year over year. Facebook has a lot going on right now. I mean, they don't know how Apple's privacy changes will impact their advertising business. They're in the middle of a metaverse initiative, and they are dealing with regulatory pressure as a result of whistleblower testimony. But like I said earlier, you wait for opportunities like this to buy a quality company like Facebook at a discounted price. Now, I've been a Facebook shareholder for a while now, and I've been adding to my position over the past couple of weeks. In summary, I think right now is a great time to start a position in Facebook using a dollar cost average strategy or whatever else strategy you feel comfortable with. I think if we looked at Facebook's stock price in a year or 2 years from now, you won't be disappointed. The third stock on my list is PayPal Holdings. Currently, PayPal is trading at $242.83 a share, and it is down $4.05 or 1.64% on the day. Now, PayPal has a market cap of $285.286 billion, a PE ratio of 59.23, and a 52-week trading range of $174.81 on the low end and $310.16 on the high end. There are currently 43 analyst price targets on PayPal stock with an average price target of $325.93, which is well above its current price of roughly $242. And if we take a look at PayPal's recommendation rating, it sits at a 1.8, which is in between a strong buy and a buy according to Yahoo Finance. In recent days, PayPal, much like Facebook, has not been a popular stock because investors were extremely concerned about its highly publicized deal to purchase Pinterest for around $45 billion. And the market reaction to the news that PayPal was going to purchase Pinterest was unfavorable to say the least, and I'm happy to report that the deal to buy Pinterest is now dead. But the slump in PayPal's share price caused by the reports of a Pinterest acquisition actually provides a nice opportunity to buy the stock at a discount, particularly going into the holiday season, simply due to the sheer number of transactions that take place during this time of year. PayPal is an absolute monster when it comes to fintech companies and the digital payments ecosystem. It's an absolute beast when it comes to the commercial transactions that we make online as consumers, and is a very strong presence in the field of peer-to-peer payments, thanks to its immensely popular Venmo mobile app, which I use quite frequently. Total payment volume at PayPal rose 40% year over year in the most recent quarter, reaching $311 billion. And PayPal added more than 11 million net new active accounts during the last quarter, pushing the total of net active accounts to above 400 million for the first time in the company's history. If you follow the fintech space or the digital payment space, you know that PayPal is a leader now, and PayPal is going to be a market leader going into the future. Now, among other things, they are not only expanding their buy now, pay later service, but they are also expanding their cryptocurrency trading capabilities as we speak. And like I said earlier, the Pinterest deal really made investors shy away from PayPal, and the stock price definitely reflects that sentiment. But now that the deal is dead, I think it's a great opportunity to dollar cost average into PayPal over the next couple of weeks or months. Alright, ladies and gentlemen, thank you all for watching this video, and if you haven't already, please give this video a like, and please make sure to subscribe to my channel because I'm regularly making content like this that is intended to help you save, invest, and grow your money. And please remember that all of the views and opinions expressed in this video are my views and opinions. Please do your own research before you invest your money in the stock market. And with that, I'm going to call it a video. Thank you all for watching. I will see you all next time.